What are lifetime gifts and how do they affect estate tax? Have you ever thought about how giving gifts during your lifetime can impact your estate tax? Let's break it down. Lifetime gifts are transfers of property or money made while you are still alive. You can give these gifts to family, friends, or anyone else. They can help loved ones financially or even assist in reducing the size of your taxable estate. When it comes to estate planning, lifetime gifts play a significant role. The federal government has specific rules regarding gift and estate taxes. There are taxes on wealth transfers both during life and at death. However, there are also exemptions and exclusions that can help limit these taxes. One important aspect to consider is the annual gift tax exclusion. Each year, you can give a certain amount to each recipient without facing any gift tax consequences. For the year 2025, this amount is $19,000 per recipient. Gifts up to this amount do not need to be reported to the Internal Revenue Service and do not reduce your lifetime gift and estate tax exemption. Now, let's talk about the lifetime gift tax exemption. This exemption is the total amount you can give away during your lifetime above the annual exclusion without incurring gift tax. In 2025, this exemption is $13,990,000. If you give gifts that exceed the annual exclusion, that amount reduces your lifetime exemption dollar for dollar. It's also important to note that the lifetime gift tax exemption is unified with the estate tax exemption. This means the total amount you can transfer tax-free during your life and at death is capped at $13,990,000 in 2025. If you use part of this exemption while you are alive, it reduces the amount available to shelter your assets from estate tax when you pass away. When someone dies, the Internal Revenue Service adds the value of taxable lifetime gifts made after 1976 to the value of their estate. This total determines the amount subject to estate tax. If the total exceeds the exemption amount, estate tax may be owed. Therefore, while lifetime gifts can help reduce the size of your taxable estate, they also reduce the remaining exemption available at death. If you give a gift that exceeds the annual exclusion amount, you must file a gift tax return. This return helps track the use of your lifetime exemption, even if no gift tax is due. For married couples, there are additional considerations. The estate and gift tax exemption is transferable between spouses. This means a couple can effectively double their exemption amount for combined gifts and estates. Also, property passing to a surviving spouse is generally exempt from estate tax due to the unlimited marital deduction. However, lifetime gifts to others still reduce the couple's combined exemption. Lifetime gifting can be a strategic tool in estate planning. It helps reduce estate tax liability by transferring assets out of the taxable estate early. However, careful planning is necessary to balance the use of the lifetime exemption and consider potential changes in exemption amounts in future years. In summary, lifetime gifts allow individuals to transfer wealth during their lifetime while also reducing the size of their taxable estate. However, gifts that exceed the annual exclusion reduce the lifetime exemption, which in turn lowers the amount sheltered from estate tax at death. Understanding these rules is essential for effective estate tax planning, especially in the context of spousal rights and exemptions.